Greetings, everyone. Welcome to Cutting Through the Noise, our monthly investment webcast. I'm Samantha Geyer, the Marketing and Communications Manager here at SignatureFD, and I'll be today's moderator. Before we dive into the presentation, let me tell you a little bit about Tony and our firm. Tony is a partner and Chief Investment Officer at SignatureFD. He chairs our investment committee and represents the firm at various industry events. Tony's a contributor on numerous broadcasts, including NASDAQ Trade Talks and TD Ameritrade Network, and his commentary has also been featured in articles from the Wall Street Journal, Barron's, the Financial Times, the Bond Buyer, CNN Business, and other prominent industry publications. SignatureFD is a financial advising firm headquartered in Atlanta, Georgia. We believe in helping our clients achieve wealth beyond money. We empower our clients to use all elements of their wealth, their time, resources, and relationships to create a financial design that helps them grow, protect, give, and live their wealth to the fullest. This holistic approach to wealth management is what we call net worthwhile. With that, I'll turn it over to Tony now to get us started.
Thank you, Samantha. So we'll, as we do every month, we'll just kind of get started with the bottom line here. So 3 things for this month. And first, rates have risen quite a bit. And that historically has put the brakes on economic growth. And but it would appear that today that's not been the case. It would actually appear that activity has been pretty robust, maybe even accelerating. So we'll talk about that a little bit. Next, we need to remember that much of the growth that we're seeing from an economic perspective right now is what the market had been discounting in the first half of the year. But now the conditions are likely in place for some sort of consolidation or corrective activity in the near term. And the headline driver of that correction risk may be news on inflation, which we do expect to accelerate a bit, but fall well short of its worst levels that we saw last summer. So let's go through some of the data and see what the charts are telling us. So this first chart here is just a look at 10-year Treasury rates thus far this year. And notice how they hit the low soon after that mini banking crisis we had in March and April. Since then, rates have gone up, and they've gone up by a lot, nearly a full percentage points, and they're currently near their year-to-date high level. Now, higher rates have historically resulted in slower economic growth. But what's been fascinating in this cycle is that growth is seemingly getting stronger. So here we're showing the Atlanta Fed's estimate of third quarter GDP. They take in real-time economic data and adjust throughout the quarter. So it's currently projecting a very strong growth rate of 5.8%, which is much higher than the steady state growth rate of the US economy, which is about 2%. Now, it appears that stronger growth prospects are the reason that rates have been moving so much higher. This chart here shows nominal Treasury yields of different durations in each clip. The black line in each of these clips is showing real Treasury yields as defined by the TIPS market. Now, interest rates are largely a function of 2 things: expected inflation and expected economic growth. The real rate, or the black lines, that's a good gauge of the growth part of the equation. So let's take a look at this third clip here, which shows the 10-year yield. Now, 10-year yields hit their low about 3 years ago, but it wasn't until very recently that real yields began to move higher. Now we can see that the nominal yields and real yields have been moving more in lockstep with each other. And so that's telling us that stronger growth expectations rather than the inflation component are what's driving yields higher. Now, if rates stay restrictive for long enough, we do expect them to have a negative impact on growth, but thus far they haven't. So why not? Well, first, let's take a look at the consumer here. Households have relatively low demands on recurring payments and relatively low demands on their debt burden. Most households that carry a mortgage have been greatly shielded from the impact of higher rates. Just look at mortgage debt service, still sitting here near all-time lows. Yes, mortgage rates for newly originated loans are very high today, but the average mortgage that consumers carry out there remains quite low. So the Fed is having a really hard time transmitting tight policy into the consumer, and businesses are in a similar position. Here we're showing debt relative to cash flow in the top clip, and we can see that it remains comfortably below average, meaning that corporations are generating plenty of cash relative to their debt load. And then in the bottom clip, we're showing the interest coverage ratio, and it's at an all-time high. So companies are generating plenty of earnings to cover their interest expenses. Now, I think most listeners of our webcast may be able to wrap their head around the fact that the economy is holding up okay, but how on earth is it actually accelerating in the face of restrictive monetary policy? Well, one simple answer is that fiscal policy is adding a large enough boost to overcome tight monetary policy. So here in the second clip in orange, we're showing a calculation that combines the fiscal thrust with monetary policy. And also it throws in the change in the US dollar. Now, the third clip in light blue shows the year-over-year change in those base calculations. Notice that the combination of fiscal and monetary policy was historically tight in 2022. But today, it's become quite expansive. So quite simply, fiscal support has picked up meaningfully this year, so much so that it's overwhelming monetary tightening. Now, on to some market implications. We think we're in for a few months of corrective action, or at the very least, a choppy consolidation of the uptrend. Let's start with the impact of interest rates on stocks. Though rates may not yet be slowing the economy, we need to remember that rates affect stock market valuations. All else equal, higher rates should result in lower valuations. Now, we've tested this relationship between rates and stock market every which way you can think of. And what we constantly find is that stocks care more about the direction of rates rather than the absolute level of interest rates. So what this chart here is telling us is that when Treasury bond yields are falling from a peak, that has historically been good news for stocks. When they've been rising from a trough, that's historically been a more challenging environment. We're currently in that rising zone, implying that rates are a headwind for the bull market. Now, another potential correction driver is the trend in inflation. The top clip of this chart is the year-to-year change in inflation. The second clip in orange is a model that's comprised of about 20 indicators that tells us how strong either the inflationary pressure is or the disinflation or deflationary pressures are. We can see that earlier this year, there was a very strong disinflation trend. But more recently, that's reversed a little bit. What we're seeing is still a moderate disinflation, but the easy part of that disinflation process is probably behind us. Mathematically, it's likely that inflation will stay firmly above 3% through January of next year, at which point it could begin to fall lower again towards the 2% target. Now, a major risk is that inflation doesn't just stay in the 3 to 4% range, but reaccelerates higher than that. That is not our base case, but it's certainly within the range of outcomes. What this chart is showing is that inflation has fallen below its average of the last 5 years, and that's historically been good news for stocks. But a reacceleration back meaningfully above its average levels could remove a major market tailwind, something we're certainly going to keep an eye on. So a couple more points here on this correction risk. First, on seasonality. In blue, this chart combines 3 different cycles to form an expectation of what this year could look like based on market history. It combines the pattern of all years with the pattern in all pre-election years and all years that end in 3. The orange line shows what has actually happened this year. Some years track better than others, but it's been pretty spot on this year. Now, the composite calls for a choppy market until we get to December. At that point, history would suggest a year-end rally is possible. Now, finally, market sentiment had recently gotten more optimistic than at any point since the end of 2021. Now, there's been an improvement here as shares have corrected a little bit, but sentiment remains at least somewhat optimistic. Some additional consolidation would likely drive sentiment back into its more pessimistic reading, setting up the next stage of this bull market. Now, at the end of the day, our base case is that the market will make it through this fall without entering a very severe correction or a bear market. Stocks have been digesting higher interest rates and various headline risks, and a pause in the uptrend makes sense. That would be completely normal in the context of an average bull market. So what this chart does, it does a great job illustrating our expectation for valuations and fundamentals. Now, the black line in the middle clip, that's the S&P 500 index itself. The red line in the bottom is the S&P 500 earnings. The blue line in the top is the price to earnings ratio. Now, all of these lines are the average pattern around all bull market start dates. We can see that historically, the market has a strong advance in the first 6 to 12 months of a new bull market. That advance has historically occurred despite earnings that are flat to down over that very same period of time. Now, the result is that valuations do tend to climb in the first year of a bull market. And that's exactly what we have seen since the October low. Then what tends to happen is we tend to see a moderation in the uptrend, but earnings do begin to pick up. Now, the result of that trend is that valuations tend to become less demanding in the second leg higher of a bull market. This pattern lines up very well with our expectations for the next several quarters. Now, the outlook for earnings is beginning to improve. In large part, that is due to the underlying economic strength and the health of the consumer. Now, in blue, this chart is showing the percentage of companies who have been revising their forward earnings outlook higher. We can see that at 78%, the percentage has climbed meaningfully. Now, the good news here is that positive earnings revisions tend to lead actual earnings by 1 year. Reported earnings is the orange line here. Now, if history is a guide, we may expect that Q2 2023 would represent the trough in reported earnings for this cycle, and earnings could move higher as we move forward. Okay, so that covered a lot of ground this month. Let's briefly recap. Interest rates have moved meaningfully higher, but that hasn't yet dented economic growth. Notably, businesses and consumers are in good shape. And we didn't touch on this earlier today, but there are actually some stimulative effects from higher rates on cash for both households and businesses. Now, a mild correction would not be a surprise to us, but we would view that in the context of an overall bull market trend, which should become supported by stronger earnings in upcoming quarters. All right, guys, that is our prepared remarks for today. I'll pause for a second to see if there's any questions for this month. Okay, I don't see any questions this month. Thank you so much for taking time out of your day to join us today, and we will catch you next month.